Over the past few months, volatility has ruled the markets. Here's the S&P 500 on Thursday, June 11, when the index fell 6% in a single day of trading. It was a rough day, but not for everyone. This chart from the same day shows the price of UVXY, a fund that's tied to market volatility. You can see, as the S&P tumbled, UVXY gained. This fund is a type of volatility trade, which is a kind of bet that has lately attracted more investors and critics. Analysts say volatility trading doesn't only benefit from market turbulence, it can actually make the swings bigger, which could make markets riskier for everyone. We'll explain. To understand volatility trading, a good place to start is the CBOE Volatility Index, or the VIX.
The VIX is known as Wall Street's fear gauge, and it basically measures market volatility, and it's based on options prices tied to the S&P 500.
The VIX tracks the price of calls and puts, which are contracts that allow investors to bet on whether stocks will rise or fall. When a lot of investors are expecting big swings, that demand can drive up the price of calls and puts. For example, on March 16, the VIX rose by 43%. A huge jump that led the index to a record close.
So on March 16th, the market crashed. Stocks had one of their worst days in history. Investors were reaching for options contracts throughout the day, driving up the prices of those options contracts because they expected more volatility in the future. And that drove the VIX up.
Now, on that day, traders were not only betting on which way stocks would go, they were also betting on which way the VIX would go. That's a type of volatility trade, but there are others too. In fact, there's a whole ecosystem of trading products that allow investors to bet on how rough or calm the markets will be. Experts say these bets, and the hedging traders do to cover them, could be affecting the market in really big ways.
So volatility started out as a metric to measure the market, but now we're seeing these products that trade volatility and the whole host of derivatives to trade volatility getting so big that some analysts say that they can actually influence the market and drive more volatility.
This current stretch of market swings comes after a decade of increased interest in this type of trading. Here's a look at assets in hedge funds that trade market turbulence. And here are assets under management for exchange-traded products tied to the VIX, like the UVXY. You can see, the volatility business took off after the financial crisis and grew from there as bankers devised new and risky ways to trade it. Both charts mark 2020 as a record high.
It's been a crazy few months for the stock market, and we've seen some of the biggest swings we've ever seen in history. And what that's done is actually that's drawn more interest to these types of trades, the volatility trades. That means people are putting more money in these exchange-traded products that bet on volatility.
For some investors and hedge fund managers, the strategy has paid off.
One investor I spoke to, his strategy is up more than 200% through May, while the S&P 500 has fallen over that time frame.
Remember UVXY? Here it is for the full year. And this is the spike we showed earlier. UVXY has had some big gains, but not everyone has won. There have also been big downward moves, leaving some investors with huge losses.
We saw just this year professional investors and professional hedge funds that trade volatility. Some of them took some really big losses or shut down entirely. Look, these are really risky strategies, and it's important for investors to proceed with a ton of caution because it's definitely not a guaranteed win for you to bet on market volatility. And even some of the most successful and sophisticated investors can have trouble with these trades because it can be really difficult to manage the risk associated with derivatives trading.
It's unclear how long this current bout of market turbulence will last, but experts agree on something. The more volatile market is also a riskier one.